Pfizer Inc. PFE is currently trading at 26.52 USD, showing an intraday gain of 0.64, which is a 2.45% move to the upside today. While a 2.5% jump might seem like a reason to celebrate if you are monitoring your individual brokerage account on a Tuesday afternoon, there is a much heavier story playing out beneath the surface of this ticker. Most people looking at Pfizer right now see a pharmaceutical giant trying to find its footing after the massive windfall of the previous years has finally dried up. The expectation among the retail crowd on Robinhood and the institutional players using interactive brokers has been that Pfizer would simply buy its way back into growth. We saw the $43 billion Seagen deal and more recently the $10 billion Metsera acquisition. The market narrative has been that these big checks would bridge the gap, but the reality is far more sobering, and it is something most analysts are only just starting to price in. Pfizer recently issued a 2026 financial outlook that actually fell short of what the street was looking for, signaling that the next 3 years might be a period of stagnation rather than the quick recovery everyone was hoping for. The curiosity loop here is not about whether Pfizer can survive, but whether the massive dividend you see on investing sites is actually a trap or a once-in-a-decade opportunity. If you look at the yield on the Fidelity mobile app or your Robinhood app, it looks incredibly juicy, often hovering around that 6% mark. But here's the part people are missing. Pfizer is projecting a double hit to its top line that most investors haven't fully internalized yet. They're looking at a $1.5 billion drop in COVID-related revenue and another $1.5 billion hit from the loss of exclusivity on some of their core legacy drugs. When you add that up, you realize that even with the new acquisitions, the company is basically running up a down escalator. The market expected the Seagen oncology assets to ignite the stock price immediately, but the reality is that integration costs and the slow pace of clinical trials mean those returns are years away. This creates a massive tension between the buy-the-dip crowd and the institutional desks at interactive brokers who are worried about the debt load taken on to fund these acquisitions. If you're engaged in self-investing or using a SoFi robo-advisor, you might be tempted to compare Pfizer to something like Nvidia stock or Apple stock, which have seen massive momentum. But pharmaceutical investing is a different beast entirely. It's a game of patent cliffs and pipeline probability. Right now, the common belief is that Pfizer is a safe, defensive play. The contrarian take, however, is that Pfizer has become a show-me story where management's credibility is on the line. They've promised over $7 billion in cost savings by 2027, and while they claim they're ahead of schedule, the market isn't rewarding them for cutting costs. It wants to see where the next blockbuster is coming from. If you're browsing for investment help or checking out Schwab Intelligent Portfolios, you'll notice that Pfizer is often categorized as a value play. But value can easily turn into a trap if the revenue growth isn't there to support the dividend. Comment below how many shares of Pfizer Inc. you currently hold and whether you're in it for the dividend or the long-term growth. Looking at the daily swings, we've seen some decent volume today, likely driven by a broader sector rotation into healthcare as investors take some profits off the table from high-flying tech names like Tesla stock. Institutional activity has been a bit of a mixed bag. Some large-cap Fidelity mutual funds have been maintaining their positions, while others have been trimming. The reaction to the recent earnings guidance was a clear example of this tension. When the company lowered its 2026 revenue forecast to a range of $59.5 billion to $62.5 billion, the stock took a hit because that midpoint was lower than the previous 2025 expectations. It's a rare sight to see a company guide for a down year 2 years out, and it shows that the management is trying to clear the decks and set a low bar that they can hopefully beat. This is the kind of detail you need to pay attention to when you invest online or manage your own Fidelity IRAs. The institutional desks at Fidelity Brokerage and Interactive Brokers trading platforms are focusing heavily on the oncology segment, which now makes up about 28% of total revenue. The Seagen acquisition brought in world-class antibody-drug conjugate technology, which is basically a guided missile for cancer cells. This is where the long-term reality might eventually exceed the current low expectations. If Pfizer can successfully expand the labels for drugs like Padcev and Adcetris, they could see a significant boost in high-margin revenue. However, the timeline for this is 2028 and beyond. Between now and then, they have to navigate the patent expirations of heavy hitters like Eliquis and Vyndaqel. This is why the stock feels like it's stuck in the mud. For someone using Robinhood Investments or SoFi Active Investing, the patience required here is immense. It's not the fast-paced world of Robinhood crypto or day trading high-beta tech. To understand why the price action is so muted, we have to look at the business model. Pfizer operates as a massive research and manufacturing machine. They spend over $10 billion a year on research and development. In the past, this led to the first-to-market COVID vaccine, which was an incredible feat of engineering. But that success created a high watermark for revenue that is almost impossible to replicate without another global health crisis. Older reports show that in 2022, they were doing over $100 billion in revenue. Now they're guiding for roughly $60 billion. That is a massive scale back that requires a complete rethinking of the cost structure. When you use Fidelity Wealth Management or a professional Fidelity trading platform, you start to see the fundamental ratios reflect this transition. The price-to-earnings ratio looks cheap on the surface, but it's cheap for a reason. Investors are discounting the future earnings because of the uncertainty around the obesity drug pipeline. Speaking of obesity, that's the elephant in the room. Everyone on the Robinhood app is looking for the next Eli Lilly or Novo Nordisk. Pfizer had a major setback when they had to scrap the development of their once-daily weight loss pill danuglipron due to side effects. Now they're trying to fix that through the Metsera acquisition and other licensing deals with biotech firms in China. This is a high-stakes move. If they can get a competitive oral GLP-1 drug to market, the stock will likely re-rate higher instantly. But right now they're behind. The market expectation was that Pfizer would be a leader in this space by now. The reality is they're playing catch-up. This is the kind of insight that often gets lost in the noise of general investing sites. If you're doing your own online investing through an interactive broker's account, you have to weigh the risk of them missing out on the obesity trend entirely. The macroeconomic pressures are worth noting too. Higher interest rates have made the debt Pfizer took on for acquisitions more expensive to service. When you're looking for investment help, you'll find that interest coverage ratios are becoming a key metric for big pharma. Pfizer's interest expense has climbed significantly over the last few years. While they have plenty of cash flow to cover it, it's still a headwind for earnings growth. On the plus side, the sector momentum for healthcare tends to be positive when the broader economy starts to slow down. People still need their medicine regardless of what the Fed does with interest rates. This defensive quality is why many people still hold Pfizer in their Fidelity Brokerage or SoFi Invest accounts. It provides a level of stability that you won't find in the more volatile parts of the market. For the future outlook, there are a few catalysts to watch. We have several Phase 3 data readouts coming up in 2026 for their oncology and vaccine programs. There's also the potential for more small-scale stepping stone acquisitions that could bolster the pipeline without adding too much debt. The biggest risk is a further decline in the COVID business beyond what they've already guided for. If Paxlovid sales fall off a cliff even faster than expected, management will have to cut the dividend or find even more aggressive ways to save money. On the opportunity side, if the new PD-1 VEGF inhibitor they licensed shows strong results in colorectal or lung cancer trials, it could be a massive win. This is a competitive area of oncology where they're trying to challenge the dominance of drugs like Keytruda. If you're using a Robinhood cash management account or looking at Robinhood fractional shares to build a position, these are the events that will determine if your thesis holds up. Let's talk about the retail experience for a second. If you're using the Robinhood stock trading interface, you see the simplified charts and the analyst buy ratings. But if you switch over to an interactive brokers platform, you see the complex option chains and the institutional flow. There's a disconnect right now. Retail is holding for the yield, while the smart money is waiting for proof of growth. This tension is what keeps the stock in its current range. To break out, Pfizer needs to show that its non-COVID revenue can grow at more than the projected 4%. They need a home run in the clinic. Without that, the stock is likely to remain a laggard compared to the broader market and the high-growth peers in the biotech space. This is a classic case where the expectation of a quick turnaround has met the reality of a slow, grueling corporate restructuring. In summary, the situation with Pfizer is a perfect example of the gap between market narrative and financial reality. The expectation was that a company of Pfizer's size could simply outsell